A few years ago, most everyday purchases still felt straightforward. You saw a price, you paid it, and that was the end of the story. No overthinking, no second guessing, no hidden layers. But over the last 2 to 4 years, something changed. In a way, most people didn't really notice while it was happening. And that's the important part. It didn't change suddenly. It changed slowly enough that your brain adapted to it. Prices went up gradually. Portions got smaller quietly. Subscriptions stacked without attention. Fees became normalized, and because it happened step by step, it never felt like anything major changed. But when you zoom out, something very different becomes obvious. A lot of everyday spending today simply doesn't work the way it used to. Not emotionally, not logically, not mathematically. So, the real question is not just what became expensive. It's this. What became quietly expensive without you noticing? Because in 2026, a lot of financial pressure doesn't come from big purchases anymore. It comes from small, repeated decisions that feel normal. And here's the uncomfortable part most people miss. You are not reacting to prices anymore. You are reacting to systems designed to hide them. So, in this video, I want to go through 12 things that increasingly don't make financial sense anymore. And, more importantly, what most people still misunderstand about them. And the first category is one of the best examples of that hidden shift. Part 1. Food delivery apps. Let's start with something almost everyone uses. And here's a simple question. At what exact moment did food delivery stop being expensive but convenient and become just expensive? Because that shift didn't happen with prices. It happened with your perception of prices collapsing slowly. When these apps first became popular, they felt like a deal. Promotions everywhere, free delivery, discounts, subsidized pricing. It felt like technology was making life cheaper, but that was never the real model. It was customer acquisition. And here's the contradiction most people never resolve. It feels like convenience saves you time, but it quietly removes your awareness of cost. Now, fast forward to today. The structure completely changed. You don't just pay for food anymore. You pay for delivery fee, service fee, small order fee, tax, tip, and inflated menu pricing. And here's the key psychological trick. None of these fees feel big individually. So your brain never registers the full cost. You see, $14 meal. Okay, fine. The final total becomes $22, $24, sometimes even $28. And because it's broken into pieces, it doesn't feel like a single expensive decision. It feels like a bunch of small ones. That's the illusion. And here's where it becomes psychologically sharper. You are not being overcharged in one moment. You are being microcharged into indifference. Now here's the real question. If this exact same meal required you to physically see the total price up front, would you still order it as often? For most people, the answer quietly becomes no. And that's the real signal. Convenience didn't just add cost. It replaced price awareness entirely. And that's the first fracture. When awareness disappears, spending stops feeling like spending. Part 2. Brand new cars. Let's talk about something that has become almost socially accepted. $700 to $900 monthly car payments. That number used to sound extreme. Now, it sounds normal. And that normalization itself is the warning sign. Because what changed isn't just car prices. It's how ownership is mentally constructed. You are no longer buying a car. You are subscribing to the experience of having one. 6 years became standard. 7 years became normal. 8 years is now common. A car is not an appreciating asset. It loses value immediately. You are financing something that is shrinking in value while you're still paying it off. Here's the psychological trap. Monthly payment makes it feel manageable, but total cost becomes invisible. Now let's make it concrete. A $50,000 car at 7% over 72 months. You don't just pay $50,000, $11,000 plus in interest, plus depreciation, plus insurance, plus long-term maintenance. And by the time you finish paying it off, the car may be worth half of what you paid. But here's the deeper illusion. You don't feel like you are renting it, even though economically you effectively are. That mismatch is where the distortion happens. Now here's the question. Would you still buy this car if you had to think in total cost instead of monthly cost? Because that shift changes everything. Part 3. Upgrading your phone every year. Let's test a belief that almost everyone has absorbed without questioning it. New phone equals necessary upgrade. But is it? Or is it just cycle-based marketing? Because if you actually isolate the differences between yearly models, they are usually marginal. Better camera, slightly faster chip, small design tweak, nothing that changes daily life in a meaningful way. Here's what does change: your perception. Every year, a new model resets your expectations of what normal looks like. And suddenly your perfectly working phone feels outdated, not because it stopped working, because something newer exists. And that's the contradiction. Your device didn't degrade, your reference point did. So, the real question becomes, are you upgrading because your phone is worse, or because your phone is no longer the newest reference point? Distinction is everything. And if you've followed this far, something important should already feel slightly uncomfortable. Because so far, we've only looked at food, cars, phones, normal life categories. But the pattern is not about categories. It's about structure. At this point, it's not about prices anymore. It's about whether you still know what anything actually costs. And that shift becomes much more aggressive in what follows. Because now we move into systems where you are not just spending money. You are being gradually trained to stop noticing spending altogether. Part 4. Actively managed funds. Let's ask a difficult question. If professionals consistently beat the market, why do most of them underperform it? Actively managed funds promise expertise, but they also introduce something very expensive: fees, plus turnover, plus human decision error. And over time, those factors compound against the investor. A 1% fee doesn't sound serious. Over 20 to 30 years, compounding turns it into a massive difference. Small percentage to massive structural divergence over time. So the real question becomes, are you paying for better results or for the feeling of professional control? Part 5. Status spending. Let's make this more direct. How much of what people buy is actually for themselves? And how much is for someone watching? Luxury spending rarely fails on utility. It fails on necessity. Because the function is not consumption, it's signaling. Social media amplified this. But here's the uncomfortable inversion. The more visible your life becomes, the less private your spending decisions become. Now the test? If nobody could ever see it, would you still want it at the same level? If the answer changes, then the purchase was never fully personal. Part 6. Fast food. Fast food used to have a clear identity: cheap plus fast plus convenient. But one of those variables changed: price. And when price rises without quality improving, value collapses quietly. Now, a fast food meal often overlaps with casual dining pricing. If price is similar, why is quality still low? And that creates a subtle frustration loop. You are no longer choosing between good and bad. You are choosing between different versions of disappointment. And that's where behavior shifts. Because people don't compare categories anymore. They compare outcomes. What am I actually getting for the same $15? Part 7. Subscription creep. This is one of the most underestimated financial leaks because no single subscription feels significant. $5 here, $10 there, $15 somewhere else. Individually irrelevant, collectively structural. And here's the psychological trap. Subscriptions are invisible spending. That's exactly why they scale faster than your income. You don't decide every month. You just continue. And that removes friction, which increases lifetime cost. The question is simple. How many things are you paying for that you would not actively choose again today? Part 8. Extended warranties. Extended warranties are not really insurance. They are fear monetization. Pitch is simple. What if it breaks? But statistically, most products either fail early under warranty or last far beyond coverage. So, the middle window is often overpriced protection. And here's the contradiction. You are not buying protection from failure. You are buying protection from uncertainty. And those are not the same thing, because uncertainty feels worse than actual risk. So companies don't sell safety, they sell emotional relief. Now, the real question becomes, if risk feels scary enough to insure, it is usually already priced into the product margin. So are you reducing risk or paying to feel less anxious about risk? And that's the hidden cost. You are not insuring the product. You are insuring your emotions. Part 9. Wellness Consumerism. Health became an industry. And industries need products. So wellness slowly shifted from behavior to consumption. Supplements, detoxes, gadgets, routines, systems, optimizers. But the uncomfortable truth, the highest ROI health habits are still the simplest. Sleep, movement, food quality, stress control. No packaging required. And here's the contradiction. The more products you buy for health, the further you often drift from actual health. Because health became something you purchase instead of something you practice. So the real question, are you improving health or purchasing the identity of being a healthy person? And that identity is expensive because it requires constant reinforcement through new purchases. Part 10. Arena concerts. Concerts didn't just get expensive. They got layered. Base ticket to fees to resale, markup to travel to food to drinks. And suddenly a night out becomes a multi-$100 decision. But here's the interesting shift. Smaller venues often outperform stadium experiences emotionally. More connection, less distance, more presence. You don't remember the scale. You remember the proximity. Let me give you a simple contrast. A stadium concert feels like watching an event. A small venue feels like being inside it. Same artist, different psychological experience. The question becomes, are you paying for the artist or the scale of the event? And most people don't notice. They chose scale over experience. Part 11. Credit-based consumption. Financing changed consumer behavior more than prices did because it decouples purchase from full cost. $1,000 becomes $80 per month. Suddenly, the brain stops processing the full expense. But here's what actually changes underneath. You stop owning decisions in full. You start owning fragments of decisions. Fragmented ownership feels lighter, but lasts longer. Because each purchase is no longer a full event. It becomes a background process in your financial life. Now here's the contradiction. Credit doesn't make things affordable. It makes them psychologically invisible. So the question, would you still buy it if payment structure didn't exist? Because without installment logic, many decisions simply disappear. Part 12. High-interest debt cycles. Debt becomes dangerous when it stops being a tool and becomes a loop. One balance leads to another. One payment gap leads to another solution. And over time, borrowing becomes normal behavior. But high interest changes the equation. It doesn't just add cost, it reduces future optionality. And that's the real damage. You are not just paying more. You are narrowing future choices. Because every high interest cycle steals flexibility from tomorrow. So the real question, are you solving a short-term gap or creating a long-term constraint? And most people don't notice the moment. When temporary borrowing becomes permanent structure. Conclusion. When you look at all 12 categories together, a pattern appears. Modern spending didn't become more expensive in obvious ways. It became more fragmented. Small costs, small payments, small decisions. But combined, they reshape financial reality. That's the real shift. Not that people are spending recklessly, but that spending has become harder to perceive clearly. That is the core paradox. But combined, they reshape financial reality, and that's the real shift. So awareness becomes the last remaining advantage. Because in a system where cost is fragmented, clarity is no longer natural. It is intentional. And the real question you're left with is simple. Are you actually choosing your expenses? Or just reacting to them as they appear acceptable in small pieces? Because in 2026, financial control is no longer about earning more. It is about seeing more clearly. What was designed to be ignored